We're living through an absolutely remarkable moment in financial markets right now. Gold just smashed through $5,000 per ounce. Silver surged back to $80. But here's what most investors are completely overlooking. There's something far more significant unfolding at the Federal Reserve that could send silver prices into a whole new stratosphere over the coming months. I'm going to break down exactly what's happening, why it matters tremendously, and what you need to be watching. But first, do me a favor. Drop a comment right now telling me where you're watching from. United States? Canada? UK? Australia? India? Somewhere else entirely? I genuinely want to know where this community is scattered across the globe. It helps me understand my audience and figure out the best times to upload content. So go ahead, drop your location in the comments. Let's see how far our reach extends. Now let's dive deep into this, because what's unfolding is genuinely historic. The Federal Reserve's balance sheet is making a dramatic U-turn. After years of deliberately shrinking their holdings, we're now witnessing the early stages of stabilization and potentially massive expansion. This isn't speculation or guesswork. This is happening right now in the actual data. And if you understand what this shift has meant historically, you'll grasp why silver could be positioned for an explosive move higher. Here are the hard numbers. Back in 2022, the Fed's balance sheet peaked at roughly $8.8 to $9 trillion. That was the direct result of unprecedented money printing during the pandemic chaos. Since then, they've been running quantitative tightening, systematically reducing their balance sheet by allowing bonds to mature without reinvestment. That strategy brought total assets down to approximately $6.6 trillion. But here's where things get fascinating. The decline has completely stopped. Total assets are stabilizing, and over recent weeks, they're actually ticking upward again. This reversal pattern from contraction to expansion looks eerily similar to previous liquidity cycles that triggered major market rallies. In my previous videos, I've been meticulously tracking global liquidity cycles and their impact on asset prices. When central banks shift from tightening to easing, from shrinking to expanding, it typically signals the beginning of an entirely new market phase. The assets that lead during these phases often change dramatically. Right now, all the data suggests precious metals, particularly silver, are positioning themselves to lead this next major wave. Remember 2020 and 2021? The Fed exploded their balance sheet by trillions. Silver rocketed from around $12 per ounce in March 2020 to nearly $30 by August 2020. That's more than doubling in under 6 months. Gold surged from around $1,500 to over $2,000. These weren't random movements. They were directly connected to the liquidity tsunami from central bank balance sheet expansion. Now, I'm not claiming we'll see an identical repeat. Markets never work the same way twice. But the conditions are setting up with striking similarities. The Fed's contraction is ending, expansion is beginning, and if financial stress cracks appear, expect the central bank floodgates to open wide. Before we continue, let me mention something important. Roughly 70% of you watching aren't subscribed to this channel. If you're finding this analysis valuable, if it's helping you see markets more clearly, hit that subscribe button. It costs you absolutely nothing, but helps tremendously in growing this channel and allowing me to keep delivering in-depth analysis like this. Gold reclaiming $5,000 and silver hitting $80 are massive numbers, representing significant moves in the precious metals complex. What's particularly striking is how rapidly sentiment shifted. Just weeks ago, we witnessed brutal selling pressure across metals. Forced liquidations, margin calls, and paper price manipulation drove prices down hard. The physical market, however, told a completely different story. Queues formed in Singapore and Australia as people scrambled to buy physical gold and silver. European dealers pulled their offers entirely. Chinese premiums through platforms like JD.com were running 90 to 100% above Western spot prices. That divergence screamed one thing loud and clear. Paper prices weren't reflecting reality. Now we're watching paper prices finally catch up to where physical demand has been signaling all along. Current data shows gold spot trading around $5,000 per ounce and silver at approximately $80. The Shanghai Premium, which I monitor closely as an indicator of physical market tightness, remains significantly elevated. This confirms that Asian physical demand continues massively outpacing what Western paper markets are pricing in. Silver remains in backwardation, meaning spot prices are higher than futures prices. Normally, futures trade at a premium due to carrying costs like storage and insurance. When that relationship inverts, it signals urgent demand for immediate physical delivery and serious market tightness. It's telling us the paper price isn't reflecting true physical supply and demand dynamics. Here's my next question for you. How many of you have been stacking physical silver? Drop a comment if you've been accumulating. And for those who haven't started yet, what's holding you back? Price uncertainty? Not knowing where to buy? Let me know because I want to create content addressing your specific questions and concerns. What most people are completely missing about this Fed balance sheet shift is that it's not isolated to the United States. Central banks worldwide operate in loosely coordinated fashion. When the Fed shifts policy, others typically follow. We're already seeing the European Central Bank, Bank of England, and Bank of Japan navigating their own versions of this liquidity dynamic. Global liquidity across all major central banks is showing clear signs of bottoming and potentially turning higher. Even more significant, there's a documented rotation happening from crypto into precious metals. After experiencing massive volatility, many investors who allocated to crypto as a monetary debasement hedge are rotating capital into silver and gold. The reasoning is straightforward. Precious metals have 5,000 years of history as money, carry zero counterparty risk, can't be hacked or frozen, and with physical markets showing tightness while paper prices remain suppressed, the value proposition is extraordinarily compelling. Let me be crystal clear about something. I'm not here telling you what to do with your money. My role is presenting data, sharing analysis, and helping you think through implications. You need to do your own due diligence, understand your risk tolerance, and make your own decisions. Anyone claiming they have a guaranteed path to riches is either lying or selling something. I'm doing neither. Let's examine what could unfold over coming weeks. I see two primary scenarios. Starting with the bearish case first, because addressing risks matters. If the Federal Reserve doesn't follow through on balance sheet expansion, if they continue tightening or hold steady while the economy weakens, we could see renewed selling pressure across risk assets. In true liquidity crises, investors don't sell what they want to sell, but what they can sell. Gold and silver, being highly liquid, often get hammered in initial deleveraging waves as investors raise cash for margin calls or cover losses elsewhere. We saw this in March 2020 and more recently. If something breaks in the financial system, whether a regional bank, hedge fund, or credit market corner, we could see another forced liquidation wave temporarily driving prices lower. Additionally, significant dollar strength creates headwinds for dollar-priced precious metals. And if equity markets stabilize with returning risk appetite, capital might rotate from safe havens like gold and silver back into stock. Now the bullish case, where data gets genuinely fascinating. The Fed's balance sheet reversal historically signals liquidity expansion beginnings. Every major precious metals rally over the past 20 years has been associated with quantitative easing or central bank balance sheet expansion. If the Fed continues this path, especially accelerating due to financial system stress, silver and gold could see substantial upside from current levels. Physical market fundamentals remain extraordinarily bullish. We've documented shortages across multiple geographies. Dealers struggle sourcing supply. Premiums stay elevated. Retail demand is robust. Central bank buying continues at record pace. The gold-to-silver ratio currently sits around 60-1, while historically averaging closer to 15-1 over long periods. Mining ratios, above-ground supply ratios, and vault ratios all suggest silver is significantly undervalued relative to gold. If silver reverted even halfway to historical norms, we're looking at prices multiples higher than current levels. The debt situation continues deteriorating. The United States has nearly $10 trillion of marketable government debt maturing over the next 12 months, the largest amount ever. Most requires refinancing at higher rates than originally issued. Interest expense on national debt now exceeds defense spending. This is unsustainable. When it becomes clear the only way out is inflation, the only way to reduce real debt value is currency debasement. Precious metals will benefit enormously. Geopolitical tensions remain elevated, the global order is shifting, and central banks worldwide, particularly in Asia and the Middle East, are diversifying away from dollar-denominated assets into physical gold. This isn't speculation, but documented data. Central bank gold purchases have hit record levels for 2 straight years. You might be asking, if fundamentals are so bullish, why such volatility? Why the massive recent sell-off? This is crucial. What we witnessed wasn't physical fundamentals breaking down, but paper markets collapsing. Selling concentrated in futures markets, leveraged ETF products, and derivative instruments, driven by margin calls, forced liquidations, and algorithmic trading triggering cascading stop losses. The physical market told a completely different story. While paper prices crashed, people lined up buying physical metal. Dealers sold out. Premiums exploded higher. This divergence between paper and physical isn't sustainable indefinitely. Eventually, one market must give. History tells us when paper and physical diverge, paper ultimately breaks, not physical. Paper contracts are just promises. Physical metal is the actual asset. When enough people demand delivery, when paper claims exceed available metal, the paper market reprices violently to reflect physical reality. We may be approaching that point. COMEX and LBMA have seen significant inventory drawdowns over the past year. Registered and eligible inventories sit at multi-year lows. Meanwhile, Eastern markets, particularly Shanghai, are seeing inventory accumulation. Gold and silver are flowing west to east in one of the most significant precious metals market developments in decades. What was your reaction seeing gold hit $5,000 and silver hit $80? Were you excited? Nervous? Wishing you'd bought more earlier? Did you see it as a profit-taking opportunity? Let me know in the comments. I'm genuinely curious how our community is navigating this volatility. For newcomers, let me be absolutely clear. I don't sell signals, courses, or mentorship. I don't run subscription services. If anyone contacts you claiming association with me and asking for money, they're a scammer. Block them immediately. What I do is provide analysis based on publicly available data and share my interpretation. My goal is helping you think more clearly, not thinking for you. Independent thinking is everything in markets. The moment you outsource thinking to someone else, you become vulnerable to manipulation and agendas that may not align with your interests. Over coming days and weeks, I'm watching the Fed's balance sheet data released weekly every Thursday, looking for continued stabilization and meaningful expansion. I'm watching the dollar index, as dollar weakness generally supports gold and silver, while strength creates headwinds. I'm watching Bitcoin and crypto markets, as they often serve as leading indicators for risk sentiment, trading 24/7 and reacting to news before traditional markets open. I'm watching the Shanghai Premium for signals of Asian physical demand and global market tightness. I'm watching Treasury yields, as rising yields from credit risk concerns can actually be bullish for precious metals as safe haven alternatives. And I'm watching for banking system stress signs, as the regional bank situation remains fragile, with commercial real estate exposure a ticking time bomb that could trigger flights to safety. Synthesizing all this, we're at an inflection point. The 40-year bond bull market is over. Interest rates aren't going back to zero without significant financial system stress first. Debt dynamics of major Western governments are unsustainable. Something must give. The Fed faces an impossible position: continue tightening to fight inflation and risk breaking the financial system, or ease to prevent crisis and risk reigniting inflation. There's no good outcome, only less bad and more bad. In this environment, precious metals serve a critical function. They're nobody's liability, can't be printed, can't be devalued by central bank policy, and have served as money for thousands of years. When faith in paper money, government promises, and central bank credibility wavers, gold and silver provide an anchor. I'm not creating fear but stating reality. You can ignore it, hope this debt situation resolves painlessly, or position yourself for the range of outcomes history suggests are possible. I don't give price targets because they create false precision in inherently uncertain markets. Anyone claiming silver will hit exactly $150 or $200 is guessing or generating clicks. What I will say is this: If you believe the fundamental backdrop supports higher precious metals prices, current volatility represents opportunity rather than threat. The conditions driving significant price appreciation appear in place: Fed balance sheet expansion, physical market tightness, unsustainable government debt dynamics, geopolitical uncertainty, and central bank accumulation. These are generational forces. The risk is timing. Markets can stay irrational longer than you can stay solvent. That's why position sizing, avoiding excessive leverage, and maintaining long-term perspective matter tremendously. Historical perspective. In 1980, silver hit approximately $50 per ounce. Adjusted for inflation using official CPI numbers, that's well over $150 today. Using alternative inflation measures reflecting actual cost of living increases, you could argue the inflation-adjusted high exceeds $300. We're currently at $80. Even taking the most conservative inflation adjustment, silver would need to roughly double just to match its 1980 high in real terms. Here's the summary. The Federal Reserve's balance sheet is reversing from contraction to expansion, historically signaling liquidity cycles driving precious metals higher. Gold reclaimed $5,000, silver hit $80, physical market fundamentals remain tight with elevated premiums, backwardation, and dealer shortages. Paper markets have been volatile, but physical demand stays robust. Rotation from crypto into precious metals appears underway. Government debt dynamics are unsustainable, ultimately requiring default, austerity, or inflation. Precious metals benefit from all three scenarios. Central banks globally continue accumulating gold at record rates. The question isn't whether precious metals should be part of your portfolio, but how much and in what form. Make sure you're subscribed so you don't miss future videos. Do your own research, think for yourself, and invest with logic, not hype. I want to hear from you. What's your biggest question about precious metals markets right now? What topics do you want me covering in future videos? Your feedback shapes the content I create. And one final question. Silver at $80. Are you buying, holding, selling, or waiting? Let me know in the comments.